Good day, fellow investors. This is the only Berkshire stock analysis video you need to watch, and the key, among other topics, through Warren Buffett's letter and annual report is that he is preparing for a big recession. For those who don't know me, my name is Sven Karlin. I have been analyzing Berkshire for a decade now. And even in March 2020, I told you that the P ratio was 10 and that the likely returns will give you a double in a few years. And that's exactly here what happened. Berkshire is up, and now we have to see how does that fit a buy perspective, a sell perspective, a portfolio fit, and investment strategy. Because whenever it comes to Berkshire, I think Berkshire is and will always be two things. A financial fortress, because it's built to last forever, and also a financial lighthouse for your investment decisions to compare to Berkshire always. Because when you look at Berkshire, this is the key, this is the ultimate 60 years of 20% per year compared to 10% for the S&P 500. There's not much to discuss here. Berkshire is Berkshire. And even if I look at things a little bit closer now, Berkshire is still cheaper than the S&P 500. It doesn't do buybacks at market peaks. It doesn't give stock options where the S&P 500 huge buybacks built to push stocks higher on buybacks to compensate management, built to compound 35% of market cap in cash, no cash. 50 years from now, Berkshire will be stronger, bigger, and here, depending on the price, I don't know. So Berkshire is about compounding and not destroying value over the long term, which is something that requires a long-term mindset, and only Berkshire offers that. So let's discuss the compounding there through Berkshire's earnings and Warren Buffett's letter. If we look at the last year's earnings, the key account there is insurance underwriting that has seen a boom and huge profits there, 9 billion for 2024. However, we must understand there that there were some specific tailwinds for insurance in the last year. First and foremost, inflation subdued. There were some disasters that allowed insurance company to price things higher, but that isn't yet reflected in the cost. So very good tailwinds, and if we compare to the past, you can see that these profits are exceptional and not something to count on when it comes to long-term investing. Also, if we compare to Progressive, their net income more than doubled from 3.9 billion to 8.5 billion. So even that growth, Progressive did better than Berkshire, and you are usually comparing the underwriting there with Progressive. But when it comes to this, also Warren Buffett explains in the letter, this money upfront, loss payments later model has allowed Berkshire to build the float. That's the key when it comes to insurance for Berkshire. And here Buffett discusses how we do not use options or other one-sided forms of compensation. If you lose money, so do we. So no options there. This is just an important note for long-term understanding Berkshire. But going back to insurance, over the past 2 decades, 20 years, the insurance business has generated 32 billion of after-tax profits from underwriting. So 32 billion on 20 years average. This includes the 9 billion from this year. That's 1.5 billion per year. And don't be surprised that maybe sometimes here will be not a positive, but a minus 10 billion, which is what always Warren Buffett warns us on disasters, catastrophes, things like that. So if I average this going forward, I think that insurance should do 2 billion to keep the float costless. The rest is just positive benefits. If we go to the next account, insurance investment income, that is predominantly from US Treasury bills, and you can see here the 350 billion in cash, earning now less than in 2024. So for the majority of 2024 until here, likely till Warren Buffett's T-bills need to be reinvested, the yield on that was 5.38%. Now it's already 4.3%. So that's 25% less in investment income for next year. Likely, as there is a little bit more money, then it will be somewhere like that, 4% on 300 billion, 12 to 13 billion. So this should be expected to be equal next year. If we go to the businesses, we see the railroad stable, energy doing a little bit better, but there were some additional costs there, I think, in 2023. Other businesses stable, and there is other that includes forex gains, things like that. But all in all, I think that if I put 2 billion or 1.5 there, I think that Berkshire is creating 40 billion of value on average per year there. And I like to use those 40 billion because it gives me, let's say, an average adjusting for the great year insurance had. That can be a bad year sometimes down the road, as Warren Buffett is warning us throughout his letter. Now we have enough data to make a valuation. For a valuation, we have the 40 billion. We also need to understand the growth ahead, 4% reinvestment from treasuries, 8% when that money should be reinvested into owning businesses, as Warren Buffett discusses in his letter that bonds are no good. And Warren Buffett will likely reinvest his money when he finds an 8% return for that 300 billion, because they increased their Berkshire Hathaway Energy exposure from 92% to 100% at the cost of roughly 3.9 billion. 3.9 billion for 8% on 3.7 billion in profits and the growth. And you can see here that he bought that at an 8%, 8-9% yield plus the growth. This is the investment return target Warren Buffett and Berkshire have going forward. And this investment insurance income should go down and should be replaced with, let's say, at least 20 billion in earnings. But that's why Warren Buffett isn't investing. The difference between 20 and 12 is just 8 billion. So he prefers not to risk to invest at high prices. He wants low prices for those investments. Anyway, the 40 new billion every year that comes in, even if just kept in treasuries, adds another 1.5 billion to the pile, to the earnings per year. So we have 3% growth there. Let's say there is inflation around 3% going forward. That's another 3% growth. And then we can earn, let's say they invest this over 5 years, that's another 8 billion added, so that's another 2% growth going forward. I think that Berkshire's earnings should grow at 8% per year. Now, just to be conservative a little bit, some disasters, some catastrophes, and we are at 6%. Berkshire is now a much bigger business than it was over the last 25 years when earnings grew 9%. Now let's put this into our intrinsic value template. Alright, so we have our YouTube free intrinsic template. You can download it in the link in the description below or on my free investment value investing course. Now, if we go to Berkshire, here you just click and it leads you to the investment table. Let me put it a little bit bigger. There you go. So I have here the market capitalization of Berkshire, 1,082 billion, and we put in the net income that I think is an average value creation at this moment in time from Berkshire. And now, if I put a growth rate of 6% over the next 10 years, and I expect a 10% return from Berkshire, and I put a 15 P ratio down the road on 2033 earnings for 2034, the intrinsic value of Berkshire is 400 billion. So that would be a normal case scenario, but there are other factors that we will discuss, like cash, like hedges, that increase that intrinsic value, that give it a higher margin of safety. This is just the start on earnings. In a more, let's say, positive case, we have growth rate of 8% and a terminal multiple that is the current one, 25, then you can see Berkshire double in the next 10 years for a good return, and then the present value is already higher at 770 billion. And in this case, in this best case scenario, Berkshire will deliver 7-8% returns per year going forward. Worst case scenario, 2 recessions, things like that, the terminal multiple goes to 12, which is often the case for insurance company, then the present value of the earnings is 300 billion. Now, if I average this out, we are at, let's say, 500 billion compared to the 1 trillion market cap, and that means that the comparison here for Berkshire is for a 5% long-term return from the company. And now you might say this is too low, and I agree, but let me show you Berkshire historical P ratio. I have this chart till 2018 because 2018 was the change in accounting rules, so this is something that gives us a representation of what Berkshire is. And you can see that in normal years, no recession, the peak is always 20, and the lows are at 15, 13, sometimes a little bit lower. You can find it at a P ratio of 10, 12 here and there. So the average historical, we are somewhere at 15 P ratio for Berkshire. And I know the market is now much more exuberant, but I would not go, let's say, farther from the 15 terminal multiple, because that is also what Warren Buffett targets, a return of 6, 7, 8% from the current huge size of Berkshire. And we have just to wait for opportunities, as Warren Buffett is doing. On valuation, I still need to add that Berkshire is Berkshire, therefore, especially now, it deserves a higher valuation than just on earnings as we did now. We recently discussed 10 tools to estimate the margin of safety, and I have also discussed how, if Berkshire would liquidate and then just sell everything, the railroad, the energy, insurance, other businesses, the stocks, I think that we would get to 900 billion for sure, minus taxes, which is always something also Buffett is concerned. So you get to that minimum of 700, 800 billion of, let's say, liquidation value. So that would be margin of safety number 1. We have also looked at other margins of safety, so book value around the liquidation value, even higher the liquidation value there, so that's something that's not shown on the books. There is this huge amount of cash, 320 billion. The business quality is top-notch. They will continue to deliver earnings over the future, grow those earnings, and really in a crazy market scenario, I don't think we could buy ever Berkshire below 500 billion. Something really crazy should happen for that. And yes, when it comes to investing, depending on how you see it fit your portfolio, we will need a lot of patience to see it closer to a valuation of 10. But a valuation of 10 can happen, especially in a recession, and Warren Buffett is waiting for a big one. That's a big statement to make, but let's look at the letter. Let's read between the lines. First, we have Greg Abel replacing Warren Buffett as the CEO, of course, and then if there is a recession, then also earnings of all these businesses would drop. Some great businesses, as Warren Buffett says, including a few rare gems, and that is standard when it comes to investing. You invest, there are a few rare gems that do wonderful, that's what you are investing for, some laggards, some average businesses, and that is real investing. But when it comes to businesses investing, he says that Really outstanding businesses are very seldom offered in their entirety, but small fractions of these gems can be purchased Monday through Friday on Wall Street, and very occasionally, this is the key, this is what he's waiting for. He's waiting for that occasion of a recession when those great businesses sell at bargain prices. That's Warren Buffett. That's how he made his 20% per year, and he's waiting again for that. Often, nothing looks compelling. Very infrequently, we find ourselves knee-deep in opportunities. Greg has vividly shown his ability to act at such times, as did Charlie. Why is Warren Buffett excluding himself? Because he didn't spend the money in March 2020. He should have spent much more, but it was a very uncertain time and it lasted just a short period of time, and that's why he says that Greg will do a better job next time the recession comes. Also discussing that cash, despite what some commentators currently view as an extraordinary cash position at Berkshire, the great majority is of course in equities, just 30%, let's say, cash on assets. But he says he agrees that cash is not good. Berkshire will always prefer ownership of good businesses, whether controlled or partially owned. If fiscal folly prevails like it is now, then you know that cash will not save you against the runaway currency. Warren Buffett sees it, everybody sees it. But businesses, great businesses, will do well over time despite inflation and the fiscal folly in America. So cash is no good. Warren Buffett is waiting for opportunities, and this is the key indication here. 50 billion of cash is the clear signal, and all what he discusses with the fiscal folly, with the debt, with this, signals that he's just waiting for a recession. Sooner or later it should come. We have not had one in the United States for 15-16 years now, which is insane, which means that the next one will be a big one. And now, is Berkshire a buy? Why not ask Buffett? If we look at 2024 acquisition of treasury stock, 3 billion, that's nothing, because if you are a big Berkshire shareholder and you call them and you say I want to liquidate, they will give you the market price. So that's it likely from Berkshire repurchases, and then you don't have to deal with markets fees of that. But if you look at the stock price, Berkshire did a lot of buybacks in 2020, so Warren Buffett did something 2021, and then a little bit less, and now we are back here to the standard that is likely to say no buybacks. No buybacks, which means that even for Warren Buffett at these levels, Berkshire is not a buy. However, if I put this into our value investing quadrant, then Berkshire is on the very low risk investment side, but let's say average 5 to 6%, perhaps 7% returns going forward, much better than much of the other stuff in the market. And when it comes to is Berkshire a buy, maybe we can ask ourselves, can you lose money on Berkshire? I don't think that over the next decade you can lose money on Berkshire, because I think that average scenario, even if the terminal multiple declines, maybe it will be 15 for a few years, then it will go to 20, and then you can immediately see here how you are already 4 or 5% per year ahead going forward there. And if it goes to 15, you simply buy more. And that's perhaps a strategy to implement in your portfolio. If Berkshire is so good, you can put, I don't know, 10% now in Berkshire of your portfolio. That's never a bad idea. If over the next 10 years something happens that the P ratio goes below 15, then you simply increase it to 20, 30, 40%. If that doesn't happen, you will gain the benefits of 7-8% per year, all else equal, growth and things being Berkshire. That is then a no-lose strategy to your portfolio. You buy 1% now, and then if it goes lower, you simply buy more. Warren Buffett will be doing buybacks. So that's the key anchor. You cannot lose. If you cannot lose, everything else is just upside. And then, yes, P/E ratio is now much higher at 20, 25, 20 something, but we can never know where will the P/E ratio go. Another thing to discuss, is Berkshire a hedge? Well, everything in a recession might crash, even Berkshire could crash, perhaps a little bit less than the S&P 500. Because if earnings go down on insurance, whatever crashes, the P ratio to 15, then we are at 500, 450, 500 billion valuation. Yes, there is the cash, so I don't think it will ever go lower than 600 billion, but that's still minus 40%, minus 50%. So not really a hedge there, and then world is going to end, Berkshire is buying businesses, maybe overpaying according to the market. Things can always turn into a negative sentiment because Warren Buffett is always doing the opposite of what everyone else thinks. There is this buybacks should give it protection, so if the market starts tanking and Warren Buffett starts doing buybacks at book value 700 billion, so I think there should be a bottom of 30% to Berkshire compared to the bottomless destruction that can happen in the S&P 500. So from that perspective, yes, Berkshire is a hedge. Now, just a few notes from the letter that I really liked here. So yen investments, he made double his money already in 5 years, but this is the key here. He can borrow and pay interest 135 million, and his dividends expected are 812. He's borrowing there at 0%, investing in 4% dividend, and that's just an investment that Charlie Munger said Warren Buffett did because he was bored, but why not take the free money, the free option that is there, if you can borrow in yens and reinvest that at a higher spread, take advantage of the spread. That's just taking advantage of free money. Unfortunately, we can't do it, but okay. Just a note here on education, completely agree here with Buffett. It's just a piece of paper, is the practicality that you needed when it comes to investing or business acumen that is key. Conclusion, for me Berkshire is always a buy. I would love to see it at a lower price as we have seen it in 2020. Perhaps it will happen, perhaps not. Warren Buffett says occasionally it does happen. Thanks for watching, subscribe if you enjoyed this, and I'll see you in the next video.